the this is all about the this is all about how the market moves. This is all about how the market moves, the different patterns we have in the market, mm, and understanding even the four major types of market structures that we have, whereby where we have the bullish market structure, the bearish market structure, the choppy market structure, and even the consolidation market structure or the sideways market structure. There's a PDF that I gave in the group. Let me check it here. I will share it again. Personally, when I'm training, I focus majorly. I focus majorly on making sure that people do understand the market structure, because market structure, it's the skeleton of the market. Just like if you see a human body, whereby um, the body couldn't be able to move if it was just only the body, but because of the skeleton, the bones, we can be able to do what? We can be able to move, jump. Those who go in the gym, do workouts, do exercise, all that. So all those are because of market structure. Yeah, all those are because of market. So all those are because of the skeleton, because of the bones. So market structure is also like the skeleton of the market. It's the skeleton of the market. Just like when you see my chart here, this market has been just moving exactly just like I analyzed it. Those of you who attended yesterday's market analysis, you remember we made the market analysis, and then everything was confirming me a clear bullish market movement. And those I trade with today have made money. Today we have made money from the market because we're already having a clear image of how we expect the market to do what? The market to move. But when you find that someone didn't understand market structure very well and is not having any added source to show him where clearly the market is heading, they cannot be able to analyze the market, and then the market moves just like they have analyzed. Yeah, I'm sorry, I'm not against other mentors, but personally I discovered that I don't know why, but I don't know why most of the mentors they love so much running. They love so much moving so fast towards completing the training, but not making sure that people really understand the market. Because when people understand the market, you don't need to keep feeding them. You don't need to keep giving them signals, entries. They can be able to do things on their own. Yeah, they can be able to do things on their own. I have a class that just completed. They completed last month, and they started real trading. But these colleagues, they have been making analysis with me, and the analysis has always been correct. Mhm. The analysis has always been of high address because I gave them time, I equipped them with each and everything that would enable them to be successful, and that's why they are starting to excel in the market. So that's why mostly personally I value I do value your time, I do value the money that you pay for joining these sessions. And I'm one of the people who believes that when I help one or two people to also change their lives, we can build a community of happy people where there is togetherness, God's love, and coordination of one another. Yeah, than just being first for people to master the market, but then they don't really understand. They don't have systems that can help them to succeed, and then they just start fidgeting in the market, keeping on blowing accounts, not having a clear direction, not being able to communicate with the market, because this market is like a language whereby you know that when you go to Iteso, you have to be able to speak Ateso. So if you can't speak Ateso, sorry, is it Iteso? Ateso, then it means that you just it means that you'll go there, but then you just be there. People they are telling you do this, you don't know what they are telling you. They are telling you come for food, for you just want to go for short call. But when you understand how to communicate with this market, the market communicates. The market communicates. Personal, as person, I'm done with my 2 days target. So tomorrow, even if I don't trade, I'm done with my target of this week up to Wednesday. But I saw this entry. There was this market came at this point. I saw the entry, but I never took it because I have a level of discipline that I do respect. So I don't know why some most of the mentors for them they are after moving so fast to complete things, but not making sure that people understand. Yeah, because when people understand, yeah, by the time after like 1 year, 2 years, after like 1 year, 2 years, you have built a community of profitable and successful traders. Yeah, so what if you want to concentrate and you master this language, just like just like the way you learned English or in other language, it's the same way that I want you to learn these things so that you can be able to communicate with the market. Not to just see the charts. You don't know what they are telling you. Eh? You are just there, no. But when you see that this market is moving like this, it's communicating that we are in a buying trend. So, market structure is the skeleton of the market. It's where other things are built on. Price action, for those of you who know price action, candlesticks, these are candlesticks. All these they rely on market structure. That's why when you see these lines of mine, support and resistance levels, the market has been moving in a way whereby it's respecting my zones, my lines. It's because of market structure. It's market structure first, and then the market moves following market structure. So two, we have majorly four types of market structure. And the first type of market structure, which I love most personally, it's called the bullish trend. Sorry, it's called the bullish market structure. And bullish market structure, this is the type of the market whereby the market is moving, going upwards. Just like you see here, this market started from down here, and then it's been buying, going upwards. So this is what we call market structure. So what do we find in the bullish market structure? So we have four types of market structure. The first one, bullish market structure. Second one, bearish market structure. Third one, sideways market structure. And then lastly, choppy market structure. So among these uh, among these four types of market structure, uh, we trade we trade in major leather. We trade only the bullish market structure, and then the bearish market structure, then the sideways market structure. We can also trade it, but when we are targeting impulse moves, as you learn, and then the choppy market structure, we don't trade it. So the major market structures we trade are the bullish market structure and the bearish market structure. Sideways, if the market happens to be in a sideways market structure, then we can also trade it. But we'll be mostly interested in bullish, bullish and bearish market structure. Why bullish and bearish market structure? Because these markets have what we call clear trends. And we say that the one of the simplest way to be successful in forex trading is making sure that you trade following the trend. So if it's a buying trend, we have to only be buying. We don't do what? We don't sell. Yeah, and then if it's a selling trend, we only be selling, we don't buy. So we are majorly interested in bullish and bearish market structure because of the trend, because those are the clear trends that we have. The sideways market structure, for it, it's there the market is just moving sideways, just like here. This market bought up to there, then it sold, bought, came down, and then it bought until when it broke with the resistance, which is resulted into this new bullish trend. So in the bullish market structure, that's where we have what we call the swinging. That's where we have what we call the. But before we go to that, let's first go through this. In market structure, we have these things whereby the market has bought, which is a certain point, and then sold, creating something like a peak of uh, mountain, and then after selling, reaching down here, then it buys again, which is a certain point, and then it sells again. So we have these things. Um, we have these ones. These ones we call them swings. this something like that. When you see that the market bought and then later sold bullish candles and then later selling candles, here are green candles, then it's red candles, and when you try to see here, you can see that the market created something like this, and then below you can see something like this, and then it bought again, creating this thing, these swings again. So these ones, this which are like, these are like peaks. These ones, and these ones down, we call them swings. These are swings. But the only difference is one. These ones up here, we call them swingy highs. Swingy highs, this is a swingy high, and then this is another swingy high, then this is a swingy low, then this is a swingy low. Yeah. Let me show you some example. When you look here, this market bought up to there and then it sold, creating something like a peak here. So these are like hills, or mountains. So creating something like this here. So this is what we call the swingy highs. The ones up, and then these ones below, we call them swing lows. Mhm. This is a swing low. This is a swingy high. Mm, swingy low, swingy high, swingy low, swingy high. So the market moves in a see whereby it's forming swing lows and swing highs. So in a buying market, we can have a rapid market whereby it's only buying greedy candles, whereby candles are buying rapidly like that. Or we can have a kind of a market where we have swing highs, can have something like this in a buying market. But when it comes to the buying market, we the swing highs, they change the names, just like I'm going to show you. So in a buying market, um, we can have a market whereby there are swingy highs. So this is a swingy high. Then this one, this is a swingy high too. So the ones up are swingy highs, and then the ones low are swing lows. Then these are swingy. So this is a swing low, then this is another swing low. then another swing low. Yeah. So in a buying market, we can have a market whereby candles are just buying rapidly, or we can have a market. Let me first show you how candles can just buy rapidly. Um, when you look here candles just bought rapidly without forming swings. Even here, we had major buying candles. So this was buying market. But candles bought rapidly without forming what we call the swingy highs and the swingy lows. These are swingy highs too. Another swingy high. Then these ones below, swingy lows. So I believe everyone has well understood that. Those things that look like peaks, we call them swingy highs. The ones up, we call them swing highs, and then the ones below, we call them swing lows. But then we have said that we have four types of market structure. Um, the first one being the bullish market structure, and then secondly, bearish market structure. And we say that those are the major market structures that we trade because they be having what we call trend. A trend in the forex trading is either going up or going down. The kind of a market whereby the market is moving sideways, it's called sideways market, whereby the market is moving in a horizontal type of movement. So this is how it is. Uh, in a buying market, so this is a bullish market. Bullish or buying market. So this is a bullish market whereby the market is moving, going upwards. Then the next thing is in a bullish market, we can have major two things. The market whereby candles are just whereby just bullish candles or green candles are just buying, or they are just moving, going upwards like that. Or we can have the type of a market whereby there are these swing highs. One, then after this one, the market creates another swing high, and then after that one, the market creates another swing high. So this is how it is. When the market forms a first swing high like this one, it's called a swing high. But then after the market selling, when it buys again and it goes beyond the previous swing high, and then it goes up. This is the level of this previous swing high. So this time around the market bought and it went beyond the previous swing high, went up to there, and then started selling, coming down, creating a swing high. But when you look here, this swing high, it's higher than this one. They're both not on the same level. So the moment you see the market creating a swing high and it's higher than, actually even if it's just here, mm, But as long as this current one is higher than the previous one, they are, they are no longer considered as swing high. So the moment the market creates a new swing high, but it's higher than this previous one, it's called a higher high swing. It's a swing high, but it's higher than the previous one. So the moment you see a swing high which is higher than this previous one, it's considered a higher high swing. Then after the market selling comes down, creates another new swing low, then it's just buying going up after having created this swing low. The moment we see that this swing low is higher than the previous one, which is this, there it becomes a higher high swing. So right now, being the fact that we have got uh, this swing high but it's higher than this previous one, it then becomes a higher high swing. It becomes a higher high. Comes a higher high, and why higher high? Because this swing high, it's a swing high, but it's higher than this previous one. And then after the market creating a new swing low, the moment this swing low is upper than this previous one, it's considered as a higher low swing. First thing is it's a low, but it's higher than the previous swing low. Let me share some example here. When you look here, this market had these two swings, this one and this one, they were on the same level, and then it bought, created this new swing, came down, and then it bought again, creating another swing low. But when you look here, this swing high, it's higher than this swing high, it's higher than this previous one. The moment you see this being higher than the previous one, it's considered as a higher high swing. Then this market, after coming down, started buying, creating this swing low, but this swing low it's higher than this previous swing low. So the moment you see something like that, there it becomes a higher low swing. And the moment we see that the market has started creating swing highs and swing lows, that's a clear communication that we are in a bullish trend or a buying trend, because in the buying trend we can have basically two things: the market buying rapidly, whereby rapid buying candles, or the market whereby the market is moving, forming after the market creating a first swing high, then it bought and created another swing high. But this, when with this swing high, it's higher than the previous one, then that becomes a higher high swing. So the market came down, created a swing low, which is higher than the previous swing low. So it becomes a higher low swing. Higher low swing. It's a low, but it's higher than. Actually, in a bullish trend, all swings have to be higher than the previous one. Everyone note this as we move on, it will help you. In a bullish trend, all swings have to be higher than the previous one, be it swing lows or swing highs. So this became our first higher low. Then the market bought, moved up, then it started going down, selling, creating a new swing high. But when you look here, this swing high, it's higher than this previous one. The moment you confirm that, it becomes a higher high swing, or it becomes a higher high. So this is our new higher high swing. Then market came down. After reaching down, it started buying, going up again, creating a new swing low. But when you compare, this swing low is higher than this previous one. And I believe everyone can clearly see it with his or her eyes. The moment you see that that swing low is higher than the previous one, it becomes a higher high swing. Sorry, the moment you see that a higher low is higher than the previous one, the previous swing low, or the previous higher low, it becomes a higher low swing. So in a bullish market, everything has to be higher than the previous ones. Then in a selling market, everyone get this as we move on, as we start market structure. In a selling market, everything has to be lower than the previous one. Let me show you. Let me give you another example. When you look here, this market carried this swingy high, then created another swing high, then created this swing low, went ahead, created another swing low, swing high. But when you look here, these things were going lower than the previous one. So something that starts becoming higher than the previous ones, when a swing starts becoming higher than the previous swings, it's no longer considered as a selling market but a buying market. In a buying market, everything has to be higher than the previous one. In simple words, that's how it is. Then in a selling market, everything has to be lower than the previous one. So I've seen that in a buying market, we have here, let's assume that the market was, so you can have something like this, whereby the market was had swing highs, but they're all on the same level. These ones we find them in the sideways market, as we will see. So after the market having something like this, the moment it goes up and creates another new swing high, and that swing high is higher than the previous one, it becomes a higher high swing. At the moment it creates a swing low, which is higher than the previous one, it becomes a higher low swing. And when it keeps on forming higher highs, swing highs and swing lows, and they are all higher than the previous ones, consider them higher high swings.
I have a question.
Yes, brother.
So does it mean that if the swings are at the same level, that is the high swing and low swing? Yeah, if they at the
Swing high and swing low.
yes, if they are at the same level,
At the same level like here.
does it mean that that is not a buying market?
Yeah, that is not a buying market.
Okay.
Like here, this was a swing high, this one also swing high, swing low, but they are on the same level. So this was in the swing, this was in the buying market. That type of movement whereby they are all on the same level, it's called sideways market structure.
Okay.
Yeah. In a buying market, everything has to be higher than the previous one. Yeah, but something like this, it's not considered as a buying market.
Okay.
Yeah.
Thank you.
You're welcome. Then let's go to the selling market. I believe right now everyone knows what swings are. If I'm moving so fast, you can tell me. Um, swings, I believe everyone knows that. Um, these ones we call them swing highs, and then these ones are swing low. So in a bullish market, we can have a market whereby there are rapidly bullish candles that are buying rapidly, or the market whereby there are where there are higher highs and higher lows. So then in a bearish market structure, let's assume that the market was having actually these ones whereby they are on the same level. So initially, like firstly, these are swingy highs, then these are swing lows. But when the market forms whereby forms swing highs and swing lows and they are on the same level, or whereby when you put your line, you can see that those swing highs or swing lows on the same level. Like here, this was a swing high and this one a swing high. They were all on the same level. Even below here, this was on the same level with this. These ones up, as long as they're on the same level, we call them equal highs. And then these ones down, we call them equal lows. Why equal? Because they are on the same level. When you put your line, like how I brought my lines here, you can find that these ones are on the same level. Even if as long as the even if these ones we call them wicks, these tiny things which are like sticks, call them wicks. So due to my experience, I could easily see that these swings are on the same level. So when you see them that they're on the same level, these ones up we call them swing highs, and then this one is low, swing lows. So then the ones whereby I've I've given you two statements. When we have higher highs, swing highs, and they are higher than the previous swing highs, we call them higher highs. And then the lows, we call them higher lows. And then when we have the market whereby the swing highs and swing lows are on the same level, or even if only the swing highs are on the same level, those ones we call them equal lows because they are on the same level. When you put when you put your horizontal line, like here, you can see that they are on the same level. So those are equal highs, and then below equal lows. Then let's go to the selling market. Don't worry, we're still handling these things. Yeah, today, Major, I want at least everyone to understand what swing highs and swing lows are, and what higher highs and higher lows are. And then we're going to be polishing them furthermore. So when you have these ones, sorry, um, when you have these swing highs there and the same level, those are equal highs. Equal highs. Then when they go, when they start going above each other, call them equal highs. Equal highs, then down. This one is down. Call them equal lows. And then when the market starts forming, when the market goes down and then it's a swingy high, but when you look at this swingy high, it's lower than this previous one. There it becomes a lower high swing. That becomes a lower high. It becomes a lower high swing. Why a lower high? Because it's a high, but it's lower than this previous one. And remember, we said that in a bearish market, everything has to be lower than the previous one. So in a bearish market, you can have a market whereby candles are red candles going down straight, or we can have a market whereby the market is having swingy highs and swing lows whereby they are all lower than the previous one. So this was a swing equal high because you had the two highs, but they're on the same level, so they became equal highs. Then this was equal low. I have some late comers. Ambrose, you're late, but I hope you will follow up with the recorded session. So this was equal low. Then the market, after creating these two equal lows, this one and this one, and after creating these two equal highs, the market moved down, started coming up, buying, creating another low, swing low. But when you look here, this low, it's lower than this previous one. Even if you just try to put your line even if you try putting a line, you can say that this low, it's lower than this previous one. The moment a low is lower than the previous one, it becomes a low swing. So this is a lower low swing, or lower low. And then after the market bought, then it started going down. Creating this swing high. But when you look here, this swing high, it's lower than this previous one. So as long as it's lower than the previous one, it becomes a it becomes a lower high swing. It becomes a lower high swing. Then market came down, bought again, creating another swing, but this swing, it's lower than still this previous one. Still, we consider it a low swing. And then market created a new swing high, but this swing high, it's lower than this previous one. It's below. It's lower or below the previous one. There it becomes a lower high swing. Then when the market later after having lower highs and lower lows, later when it starts kind of forming um, highs and lows, but these highs and lows are on the same level, call them we call them equal highs and equal lows. So you can find that after the market have forming these equal highs and equal lows, it goes and it creates a swing that is higher higher than the previous swing. It creates a swing high which is higher than the previous. So it creates this new swing high and it's higher than this previous one. The moment it creates a swing high and it's higher than the previous one, it's considered as a higher high swing. Then after selling, when it creates a new swing low, but this swing low it's higher than this previous one, it's considered as a higher low swing. So today I want to measure to understand that when when a swing is higher than the previous one, it's considered as a higher high swing. So this one is higher than this, and this one is higher than this. These ones were equal. So when we have swing highs whereby they're higher than the previous swings are considered as higher high swing, and then the lows, as long as they are higher than the previous ones, are considered as higher low swings. Then when swing highs are on the same level, on the same level horizontally, are considered as equal highs, and then lows, swing highs are considered as equal lows because they are on the same level horizontally. And then in the selling market, when you have or when you start having swing highs, swing lows, but the swing high is lower than the previous one, they are considered as lower high swings, and then the lows are considered as lower low swings. And that's how majorly the market moves. Yeah, so we're going to be going more deep about these swings. Yeah, but right now I just want to be sure that everyone has understood um, the the higher highs, equal lows, lower lows, and lower highs. Have you all understood what we have covered today? Or anyone with a question?
Yeah, I have understood.
Okay, that's good.
But my question is,
Mm,
um, where there are equal lows and equal highs, you said that is a sideways, right?
yeah, sideways market structure.
So it is not part of buying, neither is it part of selling. So what do you do when you have equal lows?
Equal lows and equal highs.
Yeah.
What we do, we trade what we call support and resistance. Buying from support, selling from resistance. As as you learn when you get to support and resistance. Yeah, so there we can do both. We can buy and sell, we can buy and sell, buying from support, selling from resistance, but with strong confirmation as you learn. So it's not like how it is in the buying market whereby we only take buy orders, or it's not like how it is in the selling market whereby we only take selling orders. Yeah, so there we can do both, but with a lot of confirmation. Yeah, or when the market is in having equal highs or an equal lows, we can target what we call targeting breakouts. Breakouts.
Breakout.
Yeah, we haven't got to that level.
Okay.
Let me show you some example here. Mhm. Here we had here in this market here we had equal highs and equal lows. Then we targeted what we call breakout, and this breakout resulted into the buying trend because the market created a swing high, which is higher than the previous one. So we
Mm.
can, if we don't want to trade within this a range of sideways market whereby we have equal highs and equal lows, you can target what we call breakout and retests as you learn, because when the market gets out of the sideways market, it starts building a trend. Like here, it came out of the sideways market and then it started building a buying trend.
Mm.
Yeah, so that's how it is.
Okay, thank you.
You're welcome. Anyone else with a question about what we have covered today? If there's no one with a question, I just hope that everyone has well understood. Yeah, as this will be part of this week's assignment. Yeah, and then don't allow to be left behind. Anything that you understand, you always ask. Yeah, so let's stop here. Have a good evening and a blessed night. See you tomorrow.